Well, thank you very much for your two questions. Let me start with the second one, and I'm going to repeat for you a paragraph that we discussed and that we slightly modified, but which essentially remains intact with a bit more force probably, which is that national fiscal and structural policies should aim at making the economy more productive and competitive, which would help to raise potential growth and reduce price pressure. An effective, speedy and full implementation of the next generation EU programme, progress towards capital markets union and the completion of banking union, as well as the strengthening of the single markets, are key factors that would help foster innovation and increase investment in the green and digital transitions. That will probably echo some of the things that you heard probably this morning when President von der Leyen presented her proposals. What is really important about the fiscal aspect is the following sentence. We welcome the European Commission's recent guidance calling for EU member states to strengthen fiscal sustainability and the Eurogroup statement on the fiscal stance for the euro area in 2025. Implementing the EU's revised economic governance framework fully and without delay will help governments bring down budget deficit and debt ratios on a sustained basis. This was discussed, and we believe that it's a very strong endorsement of the principle of discipline, so that all member states who have adhered and agreed to a set of rules under the fiscal governance framework will actually apply those rules and principles. There's a process that is underway that will take them to submit the multi-annual proposals that will be then reviewed, but this is certainly the set of rules that have to be implemented and respected. On your first question, and you give me an opening because you said what was actively discussed in the Governing Council over the course of the last 2 days, and specifically this morning. You know, I see very much the discussions we had this morning as a story of on the one hand, on the other hand. And you're only asking me a question on the other hand, which has to do with the services inflation, which is obviously well exemplified by the domestic prices that you referred to. And the domestic prices is clearly high, has slightly increased compared even with the May reading, but we believe is largely determined by what I call the WPP, which for me is the wage, the profit, and the productivity. And we spent a lot of time actually looking under the hood of wages, profit, and productivity on the basis of rather limited information, because we don't have a lot of specificity at this juncture, and we will have a lot more of that in the coming weeks and months. But suffice to say that the wages, whether you are measuring it with reference to compensation per employee, compensation per employee on an hourly basis, the wage trackers that we use, and various other instruments, including Indeed, for instance, point us in the direction of rather elevated wages, which were embedded and totally taken into account in our June projections. So this does not come as a surprise to us. There is a very large component of catching up with inflation. So nominal wages increase significantly this year in order to compensate the loss of purchasing power that has been experienced by workers over the last couple of years. What is very interesting, because we debated that including with representatives of the national central banks, is that while it will remain elevated this year, many surveys, and the corporate telephone survey in particular, the SAFE survey that is published, indicate that this trend of elevated wages declined significantly in the course of 25 and even more so 26. So directionally, that's the direction that it is heading for. On productivity, There is a limited element of recovery at very low levels. Productivity was at -1. It's now -0.6, so there is a little bit of progress, but certainly not what we would like to see. Our expectations is that with consumption picking up, with more demand, the recovery will strengthen, and that will raise productivity as hoarded employees will be asked to respond to the demand that is addressed to the goods production and service supplying sectors. So on that front, slight improvement in the month of June, and we hope to see more of that as demand picks up. On the third component, profits, it has reversed compared to what we observed in the last quarter of 23, meaning that unit profits are now down to negative territory when they were actually in positive territory in the last quarter of 23. So there has been absorption of the additional labor costs that resulted from the catch-up and from the drift in labor costs. So that's our analysis of domestic prices, but clearly it is high, and it's a component of prices that we try to observe very carefully. And that leads me to one word that you used. You used the word point. And for those of you who cared to listen or to read the speech that I gave in Sintra, I specifically referred to data dependency, which is something that was unanimously endorsed by the Governing Council today. But I also made very clear that data dependency did not mean data point dependency. So we applied that to wages, to other elements that we measured very carefully in the last weeks and that we looked at together in the last 2 days. Sorry, it was a bit long, but you addressed it from the other hand, so I had to cover a bit of ground.
Thank you, Madame Lagarde. And the next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you. President Lagarde, I have a question on the September potential rate move. Provided everything stays like it is right now, so that the indicators coming in line with what you're expecting, are we going to see a rate cut in September? Second question would be on what we are currently hearing from the United States, a possibility of higher tariffs and more trade tension. Is that something you are discussing in the Governing Council as also in terms of reinflationary effects? Thank you.
Thank you so much for your two questions. You know, the decision that was taken this morning was a unanimous decision. But what was equally unanimously determined was the fact that we were determined to be data dependent, to decide meeting by meeting, and not to have any predetermined rate path. So the question of September and what we do in September is wide open and will be determined on the basis of all the data that we will be receiving. Obviously, our projection from June will be a point of reference, but the projection of September plus all the other elements that we will be receiving will be taken into account to decide what we do in September. But there is no predetermined path, and that was very strongly endorsed by the Governing Council. The issue of tariffs that you mentioned, that's an important aspect, and we will have internal discussions within the Governing Council about the risk resulting from segmentation, fragmentation, and obviously the tariff increases that are flagged, either as to be maintained or to be increased, come into the picture. And that is particularly important given that export is one of the engines of the recovery as we flagged it. It's consumption, first and foremost, driven by the increased purchasing power resulting from nominal salary increases and reduced inflation. But it's also an increase in trade, as a result of which export out of Europe to the rest of the world would matter. And this is an area where we will be attentive, of course, to whatever political decisions are made by whoever in the future.
Thank you, Madame Lagarde. And the next question goes to Francesco Canepa of Reuters. Francesco, please.
Thank you very much, Wolfgang. So my first question is, you said that the decision was unanimous. Did you discuss, or did anyone even want to discuss the prospect and the merits of a rate cut today? And the second question is whether you feel more or less confident about inflation hitting a target in the second half of 2025 than you were 6 weeks ago.
So on your first question, you all know how those governing council work. We do a lot of debate and discussion, and we present views in the course of Wednesday, and on Thursday morning a proposal is put forward by our chief economist, Philip Lane, and then each and every governing council member says whether he supports or doesn't support the proposal by our chief economist, Philip Lane. And on this occasion, everyone was supportive of the decision proposed by Philip Lane. And as I said, it encompasses the 3 rate cuts unchanged, and the meeting-by-meeting data dependency and no predetermined rate path going forward. Excuse me. Now, you pointed to the issue of confidence, and we were not the only central bank in the world to have referred to the need to be sufficiently confident about the inflation path and the disinflationary process. I think we are at a stage where, with additional data, not data point, additional data that will take multiple avenues and forms, and that we will dissect in great details in the weeks and months to come. So with additional data, if that data actually confirms the disinflationary process that is at work at the moment, it will reinforce our confidence. And we shall see. But it will encompass a whole range of data and indication. And on each and every review of those components, we will still continue to apply our threefold approach, which will focus on inflation outlook. Therefore, it gives us a way in which we can look forward. We will also look at underlying inflation in all its decomposition, and we will look at the transmission. Those 3 components we will continue to review in the same way.
Thank you, Madame Lagarde. And the next question goes to Jean-Philippe Lacour of AFP. Jean-Philippe, please.
Thank you, Wolfgang. Mrs. Lagarde, bonjour.
Bonjour, c'est agréable de vous voir en vrai.
Ah, merci.
Sorry for the English speakers.
Mais pas encore. Mrs. von der Leyen was today elected for a new mandate of 5 years, and so clarity in Brussels, but still politically a big fog in Paris, where we are far to see a kind of well exercise of synchronized swimming, if I can make a metaphor that you may appreciate or not. So in the light of this, can you maybe share with us a comment on this new election of Mrs. von der Leyen for the next years? And the second question is, do you think monetary policy in its whole process, not just this meeting, these 2 days, but what comes prior to this, can be hampered by the fact, allegedly, that about 40% of the staff here in this House declare to suffer from burnout, according to a recent survey you may, of course, have news about? Thank you.
So in my old synchronized swimming days, the coach used to say, you have the choice. You swim or you sink. Difference will be in the hard work that you put in. There are a few things from synchronized swimming that I still have loud and clear in my head. I'm not going to comment on the policy avenues that have been flagged by President von der Leyen, because the speech was at 11 o'clock this morning. We were in the middle of our own discussions. I think that all I can do at this point in time is offer my congratulations for the re-election by such a margin. But of course, we will look very attentively at what the proposals are at the European level. For the moment, we are also very fixated on the April fiscal governance framework that has been decided and which is obviously vetted by the Eurogroup and which will see implementation in the early weeks of September. You asked me about our staff. And I would just like to say that, number one, a very significant majority, if not 80 to 90% of our staff, is highly motivated by the mission of working at the European Central Bank and for the benefit of European compatriots. I would also say that a lot of people are working very hard in this institution. And I think that all Europeans should appreciate that this work that translates into a few recommendations, into a few numbers, and into a few policy matters are substantiated by massive amount of work that is itself supported by what we call the shared services. And I'm extremely grateful to them for the work that they do, and I'm extremely privileged to lead this institution. I'm not saying that, because those would be my speaking points. I'm not reading from any speaking points. I really mean it. Second, because we have to be mindful of the very large amount of work that is discharged by many of them, we of course have programs in place. We have a lot of means and tools that are available for members of staff who feel under pressure, who feel that they're not getting the right opportunities. And we have beefed up those mechanisms. Just to give you an example, since I started as president of the ECB, we've put in place a whistleblowing procedure. We've installed a mediator who's been starting his work earlier this year. We have numbers of workshops for the leadership in the institution to understand the ramification of leadership and how it is important to not only motivate but also encourage members of staff who work in the various divisions of the ECB. And we will continue doing that. We will continue the dialogue with all staff and certainly with staff representatives. And we conduct our own surveys as well to corroborate or understand better what is at stake. But I take huge strength from the motivation of our staff and the determination that they all have to do a good job for the Europeans.
Thank you, Madame Lagarde. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Thank you. Madame Lagarde, two questions from me, if I may. Firstly, how much do you think the ECB will need to slow the economy and slow demand if wage growth does not moderate, as you've forecast that it will? And secondly, given that Donald Trump is now leading in the polls ahead of November's presidential election in the US, what do you think that if he wins, that could mean for both inflation but also growth in Europe? Thank you.
Thank you very much, Martin. On the second question, I'm not going to speculate on political development, particularly as election processes are underway and sometimes under dramatic circumstances. Of course, we have to take into account the consequences of, for instance, the increase in tariffs or policies that are determined outside of the euro area by any country with which we have either strong trade or financial links. And obviously, given the size of the US financial markets in particular, the developments taking place in the United States will be very carefully assessed to see what consequences it might have on the European Union and on the euro area in particular. On the magnitude of, I guess you're referring to interest rates movement that would be needed if the wages were not to decline as expected. First of all, I would deal with you if. You know, it's obviously a domain where we dig and we research and we try to find as much evidence, surveys, assessments as possible. And we do that with all national central banks, but we do that also on the basis of our corporate telephone survey, on the basis of all the numbers that are reported by Eurostat, on the basis of the wage trackers, and honestly, on the basis of everything that we see, the direction in 25 and in 26 is downward. And it's pretty, it's not basic, because none of that is basic, and a lot of developments have not had a lot of historical previous examples. But there was a period of 2 years of very high inflation because of the way in which employment relationships are organized in Europe. There was an element of catch-up. And because of the staggered determination of collective bargaining agreement, annual, biannual, triennial negotiations, the deferred impact of inflation is taking place now. The highest numbers that you have are in 24. Whether you look at wholesale, retail, public sector, private sector, it's in 24 that the impact is the heaviest. And the catch-up, once completed, will return the employment relationship and the collective bargaining agreement process to a more normal path. And if I'm to believe what our national central banks see in their respective numbers in the 20 member states, they see a return to numbers that are perfectly compatible with our target of 2% in the course of 25, and even more so in the first part of 26. So I'm not going to entertain the hypothesis where all that would be wrong, because there's too much corroboration of our assumptions and too much by way of both model-driven but also empirically determined understanding of what is going to happen. Now, we might be wrong. And if we are wrong, we will do what we normally do. We reassess on the basis of the data, and we take the decision, and we continue to be restrictive, more restrictive if it was necessary, so that we can return to our target in a timely manner. And that is the invariable in any of our reasoning. Return to target 2% in a timely manner.
Thank you, Madame Lagarde. The next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Good afternoon. Thank you for the opportunity. President Lagarde, I have two questions. The first question is on the decisions. And I go back to a sentence that is written, domestic price pressures are still high, services inflation is elevated, and headline inflation is likely to remain above the target well into next year. So this is not totally new, but it gives us a very good idea why you didn't cut rates today. Looking forward, without pre-committing, is anything that in here we should look at to give us some hints that a cut will come? So what has to change in a way to reassure people, citizens, that anyway we are on this trajectory of rate cuts? And if I may, my second question is if I can go back to, you already commented the Euro area bank lending survey, but if you can say a little bit more, because you said credit is weak, and is it too weak? Is normalization in financing conditions too weak, as you are in restrictive territory? And I have the feeling you will keep on staying on restrictive territory for quite a while.
Well, that's what we say very clearly in the monetary policy statement, that we will stay in restrictive territory as long as is necessary to reach our 2% target. And that is clearly the case. And we are not at target. And there's time to be had before we get to target. Your first question, what should you look at? Which means also what should we look at to confirm or reinforce our confidence that we are on that disinflationary path and that it remains broadly on track and pointing in the right direction. We must look at all components of data, all measurements, all indicators that will be coming in the next weeks and months. So this is going to be a process. I'm not suggesting that we're going to stop in September and not look and continue to look further. But it's clear that between now and September, we will be receiving a lot of information, whether it's GDP, whether it's inflation reading, whether it is wage and profit decomposition. There will be, and much more. I'm overly simplistic in that enumeration. But that's what we will be looking at, to see whether or not it confirms the path that we are seeing. So I'm afraid that it's going to be a bit of a busy summer.
Thank you, Madam.
No, you asked me a second question because you asked me about the bank lending survey. So allow me to distinguish in terms of credit, because there's a slight difference between corporate on the one hand, household on the other one. So on the corporate front, rates have gone down. I think it's at 5.1, which is 7 basis points lower than where it was. But on the other hand, the credit demand has been extremely low on the part of corporates. And when you decompose their demand, it's largely for the short term, and there is redemption for longer term credits by the corporate. On the other hand, when you look at mortgages, the rate is the same, 3.8%, but there is, and that's the first time in many months, there is an increase in the mortgage demand, as indicated by the bank lending survey. So it's a bit of a story of two sides, and obviously we would like to see a bit more on the corporate side, because that would mean more investment, which is obviously a prelude to continued recovery going forward.
Thank you. And the next question goes to Marta Villar of Negocios TV. Marta, please.
Thank you very much. For President Lagarde, in the last press conference, you said that there was a strong likelihood we were in a dialing back process. Would you say this likelihood is stronger now? And for the Vice President, what is your view on the current absence of a new governor in the Bank of Spain? Do you see us getting to September with no appointment yet? Thank you very much.
Well, on your first question of the strong likelihood of dialing back, we clearly dialed back in June, and that's when we decided the 25 basis points cut. As you have noted, on the occasion of this monetary policy governing council, we decided to hold the three rates because, of the reason that I've mentioned, while we are on that disinflationary track. At the same time, the domestic price pressures remain high, and the interconnection between wage, profit, and productivity can really constitute uncertainty around that path. So it's the story of on the one hand, on the other hand, which leads us to not make any decision on the occasion of this meeting. And for future meetings, it will be a matter of observing the data, analyzing the data, and determining whether or not we are reinforced in our confidence that we are on the path. Mr. Vice President, you have the rest of the question.
Good afternoon. Well, today the Banco de España was represented by the Deputy Governor of the Banco de España, Margarita Delgado, and I would even say that well represented by Margarita Delgado. She made her points, and it was part of the unanimous decision that the President referred to. With respect to the future, the election of the Governor of Banco de España is a prerogative of the Spanish government, and they have indicated very clearly that before the next meeting they will appoint someone there. hopefully, I hope that we will have a new governor of Banco de España before our next meeting. But it's the prerogative of the government. The only thing that here, we recommend, that's something that we recommend for all the governors, is that they have to be knowledgeable in terms of economics, finance, banking, and I hope that that will be the case again.
Thank you. And the next question goes to Santi Pignol of Market News International. Santi, please.
Good afternoon.
Good afternoon.
President Lagarde. Two questions. My first question is on growth. If it's becoming more of a concern for the Governing Council, and it seems that it could enter into your process. And the second is, we are in summer, and indeed it's a season of lots of reading. I wanted to ask you if in your summer reading list, would you include the 2021 strategy review to refresh the thoughts of what to do in the next round? And what are the areas that are likely to be revisited for the next one? Thank you very much.
Thank you so much to take care of my summer reading. I think I might do a lot of reading stories during the summer for my grandchildren rather than dive into very substantive reading as you suggested, but I'll come to that question later. So growth is obviously something that we look at carefully, and we certainly observe that we have recovery. It's a recovery that is led by services, supported by what we call the virtuous circle between higher employment in services and consumption of services. I remind you that service production was up 0.7% above Q1 level. That was the number in April. The service PMI remains expansionary, a tad lower than where it was, but still very expansionary. And the total employment in services has also significantly contributed to the increase of employment in Q1. So services is definitely leading the way. It's clear that on the manufacturing side, it's not the case, and manufacturing has actually declined in the last few months. And the other aspect, which we are also looking at very carefully, because it helps to have a forward-looking vision, is the level of investment. And investment remains weak, driven also by the tight financing conditions and by the uncertainty experienced by the corporate. But we have recovery, and we will continue to observe carefully where it is coming from. Suffice to say at this point that it is service-driven, not manufacturing-driven, and that investment could certainly be stronger going forward. The other element which I pointed to earlier on is this issue of exports. And I think that this is also a domain that we will look very carefully at to see how the numbers are faring going forward, and in particular, what is the competitive position of the European Union and the euro area relative to other economic nations, in particular China. So to come back to your question, which is really, what are you going to do with the strategy review? So it is not a strategy review. Let's be clear on that. It's an assessment of our strategy review. The strategy review that we conducted back in 2020, 2021 was a massive exercise that we conducted after, I forgot whether it was 14 or 18 years of no strategy and no strategy review. So it required that we really, as I said at the time, we turned every stone and we looked at everything that we use, that we decide, how we decide it, how we communicate it. And we will assess what has been achieved, where we have been short, where we can improve, and that will be not the lengthy process that we had, but a shorter process. It will start reasonably soon, and you should expect outcome in the second half of 25. And we have deliberately excluded any discussion concerning the symmetric 2% medium term, so the inflation target will not be debated. It can be debated, in the future by a future president of the ECB, but not on my watch. And the other item that also we will exclude is the discussion of the dot plots, given the experience that some of my colleagues have had of this element.
Thank you. And the last question goes to Anna Karismo of the Finnish daily Yle. Anna, please.
The Finnish Broadcasting Company. Thank you. Thank you for the opportunity. The inflation is running at very different paces in different EU countries. For instance, in Finland and in Italy, the annual rate is under 1%. And actually, we would need a rate cut. So isn't it a problem, or how big a problem is it for the ECB's council that for some countries the rates are too high, and that actually we would need a rate cut for growth?
Well, thank you for your question, but that is the beauty of the euro area. It's the beauty of Europe, but particularly the euro area, because we are a monetary union and we are 20 different fiscal jurisdictions. As a result of which we have discrepancy or disparity, if you will, between some countries and others. It was the case exactly in the other direction at the time when inflation ran very high, where you had Nordic countries or Baltic countries, where inflation was hitting in the 20 plus, when the average was much lower, and the peak on a euro consolidated basis was 10.6. So this is the reality that we have, and we have to deal with it. I have to tell you that each and every governor, when he or she walks in the governing council room, is a member of the governing council and not the representative of his or her country. I'm not suggesting that it's not in the back of their mind, because of course they come from there, they return there, and they are very much aware of the reality of their economy, but they also know that we are making decisions for the euro area at large, and we cannot make, specific decisions that would be nationally and member state based.
Thank you. That brings our press conference to an end. We will be back here on...
All right, that was ECB President Christine Lagarde speaking in Frankfurt. The bank did not move the level of the deposit rate, which it cut in June, but said it's watching the data, not the points, but the broader data, and that the question of what to do in September is wide open, to quote Madame Lagarde. Let's get over to Bloomberg's Lizzy Burden at the ECB in Frankfurt. Lizzy?
Yeah, Matt, September wide open, very much a live meeting, even if they didn't cut today. As expected, a unanimous decision, but caution very much the watchword here in Frankfurt from Madame Lagarde just there. I just want to take you back to the April guidance around that decision. They said basically if conditions were right, it would be appropriate to cut in future. And then in June, despite cutting, they said that they'd continue to follow a data-dependent meeting-by-meeting approach. Well, today, Matt, they've stuck to that language, copied and pasted it and added a line. They've said that they're not committing to a particular path on rates. So they're not reintroducing the easing bias here. This is a Christine Lagarde, I would venture to say, who's been somewhat burned from the experience of over-telegraphing that June cut. But for hints, you heard our colleague Alex Weber prodding her to ask, what's it going to take to get this September cut? And she replied, domestic inflation is clearly high, but they've got limited information now. You've got to think what they'll have by September. They'll have 2 more CPI prints, data on wages and productivity. They'll know what the Fed's going to be doing, and the French politics will have shaken out, perhaps. So they also will know, she says, they know already that wage growth is moving in the right direction, and growth risks are tilted to the downside. So from all of this, I have to say, Matt, the markets aren't buying the caution. You've got traders pricing an 80% chance of a September cut now. It's a dovish reaction despite treading a careful line.
Exactly, a dovish reaction, even as the ECB tries to maintain optionality here. Our thanks, of course, to Bloomberg's Lizzy Burden at the ECB in Frankfurt. Meanwhile, you take a look at U.S. markets. Of course, we opened about 9 minutes ago, and we're rebounding from yesterday's losses. You can see the S&P 500 up about 0.3%. Big tech is your big winner today so far. The NASDAQ 100 up about 0.6%. Of course, we saw a 3% wipeout yesterday when it came to that index, so a little bit of a relief rally here. here, and the Russell 2000 also falling yesterday, also seeing a little bit of green today, up about 0.1%. Now, one stock to watch at the open, that is Domino's, falling after reporting weaker than expected sales growth. That's despite discounts and new product launches such as New York style pizza. But Sonali, shares down currently about 12%.
Katie, I'm also keeping an eye on D.R. Horton. Shares of the home builder are slipping as high mortgage rates continue to put pressure on orders in the entry-level market. But D.H. Horton now actually slipping into positive territory, now up about 7.6%, really bucking the trend here that was before market.
And United Airlines bouncing back this morning after an earnings miss sent shares lower yesterday. Let's take a closer look at the travel sector with Bloomberg's Abigail Doolittle. Abby?
Well, in fact, Matt, we do have the shares of United Airlines sort of all over the map. They had been up 5% at the highs and then down on the day. I'm not sure where they are on an intraday basis, but investors really trying to digest mixed results. On the earnings side, the adjusted earnings for the second quarter beat by about 5%, but the earnings guide for this current quarter well below the estimate of $3.38, a miss by as much as 19% potentially. They are saying what Delta said, which is the discount airlines are causing them to have to discount as well. But I would also suggest that maybe investors, or excuse me, consumers, investors too, maybe paring back a little bit from the quote-unquote revenge travel. In addition, inflation. Let's take a look at one more factor, though, that was not discussed, and that is oil. This is a year-to-date chart of, in white, we're looking at the S&P 500 airline and travel sector. In orange, we're looking at oil, and you can see that for much of the year that the airlines were absorbing higher oil. Well, that's simply not the case. More recently, there's about a 10% spread. So I would suggest we keep our eyes on oil, the direction of oil, for more of a tell on what could be ahead for airlines.
All right, Abigail Doolittle, thank you so much. Let's also talk about NVIDIA, because shares are bouncing back this morning after selling off the last couple of days, currently up about 2% or so. And joining us now with more is Andrew Slimmon. He is Senior Portfolio Manager and Head of Applied Equity Advisors at Morgan Stanley Investment Management. So NVIDIA, Andrew, of course, it's down about 11% since July 10th or so. And it sounds like you're saying that this is a buying opportunity.
Well, I think Taiwan Semiconductor in their stellar report last night reminded investors that fundamentals are very, very strong. There's always going to be, kind of noise around it, but at the end of the day, fundamentals win out. And I think NVIDIA was massively bought up in May into mid-June. We've had a 14% correction in the stock. I'm not putting my finger and saying this is the low, but these are the opportunities you want to take advantage of to accumulate companies, that are doing well. And I look back to last summer, and we started buying NVIDIA back then, and the stock basically traded flat to lower through the summer. Before it took off. And I think this is an opportunity to begin to increase exposure if you don't have it or if you've pared it back previously.
The concern, Andrew, yesterday was the Biden administration floating the possibility of using the foreign direct product rule to curtail chip sales or equipment sales into China. That's what hit really the whole sector. Do you see NVIDIA as susceptible to issues if that happens? And do you see any likelihood that the Biden administration is going to actually do that?
Well, I mean, Matt, keep in mind, NVIDIA's chips are sold out. They can't produce enough chips. They don't need to sell into China. They've got a client base that is falling all over themselves trying to get hold of chips. So I don't think China's sales is the determinant of NVIDIA if that was to close. I think there's other risks for NVIDIA, like their big clients stop buying. That would be a big risk, but I don't think China is the real issue for NVIDIA.
Is Taiwan a risk, Andrew? Because NVIDIA chips are actually made in the People's Republic of China, right?
95% of advanced chips are made by Taiwan Semiconductor, 90 to 95%. Unless you want to go back to using just your iPhone, 8, whatever, 10, that's an issue. So again, I think it is a extremely important company as AI advances forward.
Andrew, we understand you like NVIDIA, but what about the rest of the large cap tech names? What else do you like headed into earnings season? And does anything start to still look too expensive to you on a multiples level here? I understand that you do see earnings growth for a lot of these names, but what's best to stay invested in at this juncture?
Right. So last year, when we started buying NVIDIA, people said, well, it's expensive. You know, it's trading at 40 times forward earnings. That's expensive. The flaw in that logic is that analysts got the denominator, the E, massively wrong. It turned out if I went back and stuck in what they actually earned in the last 12 months, a year ago, the stock was trading at about 10 times earnings. So be wary of what's cheap, what's expensive based on what Wall Street is estimating, because sometimes it can be wrong. And what we've seen out of these very large tech companies is they consistently have produced stellar results. And so that's why in this period where they've been sold off, but we're heading into earnings season, I think that's a great opportunity to increase exposure. So I think a stock like Microsoft that's lagged is another example of one. And you know, look, I've been in this business a long time, and I've been sucked into some of these rallies in my career where you're like, oh my God, these bottom fishing stocks starting to recover, and they go up, and then suddenly you get to earnings season and they remind you why they're at a 52-week low, and you go, what was I doing buying that company? It's a dog. And if the small cap, I'm delighted there's been broadening out, but just be wary that what's driven this rally is high risk, money losing stocks.
Right.
And we're about to go into earnings season where many of these companies will remind you they're not doing so well. And so I think it's a on the one hand, it's a dangerous setup to chase. On the other hand, it provides opportunities, whether it's in the value area or growth area, to find companies that are doing well. And it just so happens we've had this big rotation into some of the value areas. So it makes me go and say, well, what companies are doing well, guiding higher, that have underperformed recently, where I think I could get my hands around valuation, and I come back to, I can't believe it because I wouldn't have told you this a month ago, I come back to many of these large cap tech stocks.
Right. Well, Andrew, we have less than a minute left, but let's just draw a line under that point, because we've spoken to plenty of people over the past week or so that said that, okay, we get to earnings season, this rotation that we're going to see, you're going to see earnings justify that. It sounds like you're taking the other side of that trade.
I mean, I understand. You know, you showed building a building company, and it's round. These companies are very sensitized to rising rates. But, you know, just because the Fed might cut in September does not validate that there's a rotation from poor fundamentals to good fundamentals across many, many sectors. I think that is a very dangerous assumption. And that's why my experience is companies that beat don't go down for long, and companies that miss don't go up for long. And I'm willing to bet on the kind of the secular trends of certain industries versus an assumption that the Fed cutting once is going to cause a major change in those secular themes.
Got it. Andrew, great to get some time. Thanks so much for joining us. Andrew Slimmon there of Morgan Stanley Investment Management. Now, this is Bloomberg Open Interest. Let's get a quick check on what's going on in stocks. Right now, you can see the S&P 500, 18 minutes into the session, up about 0.2%. The NASDAQ a little higher as those big cap tech stocks bounce back. But it's not hurting the small caps. The Russell is also in the green. Katie?
All right, it's time now for some of our top calls. The analyst action in focus this morning. And first up, Morgan Stanley upgrading the gap to overweight. The analyst cites confidence in the new management strategy and sees positive potential for earnings revisions this year and beyond. Next up, Citi raising VF Corp, the apparel and footwear company behind Vans and North Face, to a buy. The analyst says that the sale of its Supreme brand removed an overhang from the stock.
And one stock we're watching this morning is Blackstone, the company reporting earnings that missed on profit estimates, weighed down by the firm's real estate arm. I spoke with President and COO John Gray earlier on the quarter.
We think it was another strong quarter because the forward indicators for the business were so positive. We were super active deploying capital in the quarter, $53 billion invested or committed, which is the busiest quarter for us in 2 years, and we raised nearly $40 billion. What I would say as it relates to the property sector, healing of a market that's been under pressure takes a bit of time. As you'll recall, back at the beginning of the year on our Q4 earnings call, and I think on your program, I said that I thought real estate was bottoming and that we would deploy a bunch of capital. And that's exactly what happened. What we've seen in the Green Street property report is that asset values have basically bottomed. They've begun to rise a little bit. We've also went out and deployed more than $15 billion in real estate. And so we're in that process that feels like the global financial crisis. I would say as an exception, by the way, the office market is going to take longer to heal because of the big vacancies. But if you went back then, what we saw was we deployed a lot of capital after the crisis, and then markets start to come back and you exit. So it takes a little bit of time, but certainly cost of capital coming down. Borrowing costs have come down a bunch in real estate. If you were borrowing back in the fall, it would have cost you maybe 8% for a real estate loan. Today, maybe less than 6%. 10-year treasuries have come down. The CMBS market's reopened. So we just view this as a process. It takes a bit of time, but the healing has begun. And with that, you'll see more transaction activity, certainly as you get later in this year and into next year. So it doesn't happen overnight, but there are some positive signs for sure.
Personal question for you. I know there are differing politics inside of Blackstone, of course, but you yourself have been a large Democratic donor, have supported President Joe Biden in the past. There are now increasing calls for him to step down from the presidential race, hand the baton off, perhaps. How do you feel?
Well, the president is a good man. He has been a wonderful public servant. And like Speaker Pelosi said, he's gotten the votes in the Democratic primary. This is his decision. But I would hope he considers the really extreme physical toll of this business, of this job, I should say, over the next 4.5 years. And so, again, his call, but it is a very challenging physical job.
Are you looking to support Kamala Harris instead?
I'm going to wait and see what happens here on the Democratic side. I am a Democrat, but I'm going to let the process play out.
If Trump were to take the office after the November election, what would be the biggest change, you think, to the economy and markets?
Well, I think there would be a couple of them. Regulatory change could be pretty significant, particularly in the area of M&A and antitrust, which has made deal-making a bit more challenging. I think on the energy side, the approach towards hydrocarbons and drilling would change pretty significantly. I still think renewables are a key part of the mix. We've got a real need for power. If you think about it in this country, power demand the last decade or so has been flat. It's now projected to be up 40%. Part of that is digital infrastructure. Part of that is this manufacturing resurgence that we've seen. So I think we'll see a change in energy policy. And then you talked about it. We could see a different environment for tariffs.
If you think about the election cycle and what we have seen so far, do you have any concerns as a business leader about unrest in this country?
I have a lot of confidence in this country. We have an incredible Madisonian system. We have so many patriotic people who are Republicans or independents or Democrats. I think most people want to see economic prosperity, want their children to have better lives, want the country to be safe and secure, there to be freedoms. I really believe ultimately, even though there's a lot more friction, social media, I think makes it tougher. I actually think people's goals are similar, and I think we'll find a way to get through this. The events of the last couple of weeks, particularly the assassination attempt, was very disturbing. There's no place for that in our country. And I really think we'll find a way to move forward. I have a lot of confidence in this country, and I know our firm does as well.
That was my conversation with Blackstone President and COO John Gray a little earlier this morning. And guys, a couple of other things that he said to me, of course, spoke a lot about the geopolitical landscape, but also was very sanguine about the interest rate path, believes that election risk really won't wipe away the opportunity for the end of the year as interest rates decline and perhaps deal making starts to come back at a faster pace. Blackstone deployed as much as they have in 2 years in the second quarter. So they're putting money to work. Now selling is going to be the big question.
Yeah, if you take a look at the shares, I was actually just checking BX stock. It's at the highest level since 2022. You take a look over the past year or so. I mean, shareholders are clearly hearing what they have to say, liking it, even though if you take a look at just the overall earnings headline, what they reported today, the profit did miss estimates.
I thought it was also interesting that he said the regulatory changes could be significant, and that could affect so many different industries, but Wall Street for sure. The idea that they would make things easier for people on Wall Street, which I think everyone accepts, right, kind of flies in the face of J.D. Vance's speech yesterday, where he said the Republicans are done catering to Wall Street and are going to commit to the working man. So there's a lot of politics, but the reality is that Wall Street still expects the breaks it's gotten to be amplified.
And both sides clearly have had issues with certain policies on Wall Street. So we'll see how that plays out.
All right, coming up in the next hour, Steve Tananbaum joins us. We're very excited for this. He is the founder and CIO at GoldenTree Asset Management, and they're very active in one of the hottest trades on Wall Street this year. We're going to talk to him about risk transfers. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And bouncing back, a rally in big tech props up stocks while evidence of labor market cooling bolsters the outlook for rate cuts.
Plus, it's showtime for Netflix. Analysts turn bullish ahead of the streaming giant's results due after the closing bell.
And Trump delivers his primetime RNC speech tonight as Biden battles COVID and fresh calls to quit his re-election bid. Let's get a check on these markets right now. Of course, we are seeing that bounce back. Whether it's a dead cat bounce remains to be seen. But at least for right now, the S&P 500 up about 0.3%. The NASDAQ 100 big tech as well higher by 0.4%. Fell almost 3% yesterday. Not seeing that this morning. Then you take a look at the bond market. Relatively quiet, even though, of course, we did get initial jobless claims coming in higher than expected this morning. But the 10-year yield currently camped out just below 4.2%, Sonali.
And we're going to talk more about the credit markets now. Joining us to discuss major themes he finds investable in this current environment is Steve Tananbaum. He's founder, managing partner, and CIO at GoldenTree Asset Management. Steven's a veteran of credit markets with over 30 years of investing experience, knows a lot from the credit markets to equity markets. I do want to start here with you on a trade that's been pervading markets here. This idea that the banking system is going to face a ton more regulation. They have been saddled with prior investments in credit that were made in a very low interest rate environment, now offloading those assets. Now, what does that look like from your side?
So first, let's look at it from the bank side, which is if you can free up capital. So imagine if you took a loan of $1, and the idea being that you could get the same regulatory capital, even more, if that loan was only if you had on your books had 80 cents and you were able to sell that 20 cents, you would get more regulatory capital than if you had the dollar on your books. So that's the arbitrage, that they get more capital, it frees up capital. The view from the regulator is, well, the bottom 20%, the bottom 15% is somebody else's risk, the junior part, the most junior part. Now, what the buyer sees is the opportunity to get a very attractive return. And they're usually a pool of assets, so they're commingled together. And what it compares to, probably the best comparison is structured products, where you look at an index or a collection of credit card receivables, et cetera, and that's what or CLO debt, that's what it's compared to. And usually the risk equates to about a BBB or a BB. And you get about 500 basis points more of return than a comparable BB, BBB of credit cards, CLOs, et cetera. And yes, it's bespoke, but you're getting paid for the extra work.
How large are these deals? To get a sense of how big they can get, are they sizable for you?
Oh, absolutely. We've done probably $10 billion of face in the last year. And
alone?
Alone, yes, of face. But usually there's a lot of leverage because you're taking the bottom part, the bottom 10 or 20%, so it's much smaller. And then we can get leverage on that bottom 10%. And what we look at the risk would be a multiple of 2008 experience. So we feel like the risk equates to double to triple B, and we're being paid a pretty fair spread over what those other like assets would yield.
Mm-hmm. So we're talking about risk transfers here, and I'm wondering, I mean, obviously you see this opportunity right now. How long will this last? I mean, is this something that is an endurable, sustainable trade that you can do, or is this more moment in time?
I think both. I think that there'll always be regulatory arbitrage. Right now, your premium over alternatives is pretty wide. And I would say we've seen this in other markets. You've seen it in, for instance, private credit. You got very good premium, and that premium's collapsing. And more generic, you can take out the parts of the deal you don't like and keep the deals you do like, you're still able to do. That's gonna, my guess is, go away over time. So, and that spread may not be 500 basis points, maybe it'll be 200 basis points. Because it's bespoke, it should be at a premium, because if not, you could just buy liquid, basically tranches of different indices, and that would be the way to go.
And so really interesting stuff on risk transfers. I know Sonali's been covering it closely. It really feels like a lot of people have this under a magnifying glass. But let's broaden out a little bit. I want to talk about other areas where you're finding opportunities, especially in the single name universe. You sent us over a list of some of the names you're looking at. And what stood out to me is that these don't all fall into necessarily one industry or one sector. And I mean, when you're identifying these opportunities, what does the decision tree look like?
So we started about 25 years ago as a multi-strategy credit firm. And the idea was we want to be able to line up all the different opportunities and then compare them. So not only all the different bond opportunities, but what about structured products? What about loans? What about convertible debt? What about, you may be able to have some equities which you can create the same assets cheaper than where debt's trading and arbitrage. So, what this, so the disparate and broad ideas we gave you is a function of that.
So talk us through some of those trades. It's essentially distressed in equity form, right? And I think you call it a reorg stock. So Cineworld, for example, is a name that I think we all know. How's that story play out, and when did you decide to get in?
So we got in, so Cineworld owns Regal Cinemas. That's what most people would know it as. And we got in, it's a great question, Matt, because we got in after the bankruptcy had been finalized. And what we saw was an industry where you had good earnings to look forward to, that, you know, coming from COVID. We felt that there was a bunch of CapEx that they deferred during COVID. But for instance, the easiest return on invested capital in the movie industry is basically putting in first-class airliner seats. And those have had a real good return on capital. So that's what Regal is going to be doing now. And in terms of the, if you look at the strike of last year, it's going to be a beneficiary of 25 in terms of the movie slate. So we feel you have good earnings to look forward to. The create was very low in terms of per screen on a multiple of cash flow. Cinemark fared much better than Regal or Cineworld did. And we feel like before COVID, they had similar results. We think after, you know, by 25, 26, those results will converge. There's a big spread. Now, Matt, we talked about the equity, but really the easiest investment, and by far the majority of our investment, was actually in the debt. You know, the post-reorg debt had great terms. It was written for the creditors, not for the equity, and was a loan to value of around 50% and yields about 13 plus.
Steve, I'm really curious about these trades because these are presumably of companies that could face restructuring issues one day. I mean, are these trades for the faint of heart? Would you recommend anyone to do them at home, or do you need a special edge to get in?
Janelle, great question. The short answer is, why did a company have trouble? So if it's a moment in time like a pandemic, okay, that's, if you're, there'll be there'll be a lot of other industries that have issues, or a lot of other companies that have issues if you have another pandemic. So if you can get a reasonable balance sheet, it shouldn't be for the faint of heart. When you look at companies which, you look, for instance, in media and telecom, where there's some structural issues, that's something to be thinking when you're doing distressed of, hey, does this make sense? Another example, for instance, pharmaceutical companies, Endo and Mallinckrodt, went through restructurings. They had opioids were part of their product line, and in order to address their liability, they had to go through a bankruptcy. After the bankruptcy, those liabilities have been addressed. So we would say that those are healthy companies that amortize their debt, are growing, and are very responsible.
I want to go back to the media world, because Warner Brothers is a fascinating story today, reported out by the Financial Times, that David Zaslav is considering splitting the streaming and movie services from the TV business. What's your take on that? You seem to have an edge in media at GoldenTree, and would you get involved in it?
Absolutely. It's I think the knee-jerk reaction is, oh my God, they're going to leave the creditors with the worst assets, and that might be the case. But right now, generally, when you have a conglomerate, the instinct is to value the conglomerate at the worst assets, particularly if the worst assets are a significant part of those assets. So if they have attractive growing assets and they can get them under a different spotlight, they're going to cut. You have a chance to have 1 + 1 = 2.5, 3, and I think that's what he's going for. And from a creditor perspective, if you can participate in some of that value, it may not be a negative. So it could be a negative, but it depends how it's structured, and the devil's in the details. For the equity, you're going to be mirrored in mediocrity, because you're only going to be valued as your worst assets, and we see this in conglomerates, again and again. So I think it's a smart move, and we'll see how it develops.
Stephen, we really appreciate your time here. Can go across industries. That is Stephen Tananbaum of GoldenTree Asset Management. Let's go to look at the stocks moving this hour. Here's Abigail Doolittle.
Well, we clearly have to check in on yesterday's big trade, and that was the chip trade. But today we do have a bit of a bounce back, as shown through NVIDIA. This is a 5-day chart. Today is the first update in those 5 days, so you can see still a ways to go back from the decline. And in fact, from the peak many weeks ago, this stock is still down 14–15% as investors worry that maybe too far, too fast. And of course, the Biden administration warning that there may be some more crackdown on chips related to China. As for the rest of the big tech trade, it's a bit mixed at this point. We have Apple, Amazon, and Microsoft still lower, not down in a huge way, but these are the big point drags on the index. Meta is one exception, though, up 2.2%. The company is weighing a possible buy of the Ray-Bans maker as they really continue to make a push into smart glasses. And then finally, earnings. We have two, both of these stocks higher. DR Hordern up 11.5%, the best day since November of 2022. The revenue view is better. The orders estimate missed. They're looking past it, and the quarter that was delivered was solid. And that is true, too, for Quintus, the uniform and work apparel company. They beat strong margins. Investors like it, Matt.
Abby, thanks so much. Abigail Doolittle there with a look at some of the stocks moving right now. Coming up next, we're live in Milwaukee as Donald Trump gets set to formally accept the Republican presidential nomination in a primetime speech tonight. This is Bloomberg. Let's get now to high interest to look at what's making headlines around the world. Former Dallas Fed President Robert Kaplan may loosen policy, or said policymakers may loosen rates in September in light of recent progress on inflation. However, he added the move isn't likely to mark the beginning of a full-fledged rate cut cycle.
Whatever happens, the Fed is planning and gearing up to cut rates in September. Won't move in July, but they'll move in September. The Fed, though, its path, I think, for September is pretty clear. I think there's a good chance they could do one more cut in December.
Goldman Sachs stock analyst Jim Covello is casting doubt on the hype behind the AI rally. Covello says a reckoning is coming. It might not be this year or even next year, but at some point, he says, it's happening. As he sees it, hundreds of billions of dollars companies are pouring into AI won't set off the next economic revolution or even rival the benefits of the smartphone or the internet. Morgan Stanley elevated several bankers in its first big revamp since Ted Pick became CEO. Tom Miles is said to be leading its global M&A practice alongside John Collins. And speaking of the M&A practice, Morgan Stanley's dealmakers are in the spotlight today. The firm is said to be working with Meta as it explores buying a stake in EssilorLuxottica, the maker of Ray-Bans. This move accelerates Meta's push into smart glasses, if it's actually true. Citadel founder Ken Griffin has reportedly paid Sotheby's nearly $45 million for an almost complete Stegosaurus skeleton, the most ever for a fossil at auction. The 150-million-year-old dinosaur, nicknamed Apex, was only expected to fetch up to $6 million. But Griffin has a history of trophy purchases, outbidding crypto investors in 2021 to buy a first-edition copy of the U.S. Constitution. Griffin reportedly plans to put Apex on display at a U.S. museum.
So I understand that $45 million is a lot of money. It's certainly more than I have. But for a dinosaur skeleton, I would have thought that it'd be much more than that. There's not going to be any more dinosaurs, Sonali.
That's true. There is a scarcity value here, too. And I think back to when Ken Griffin really sought to buy the U.S. Constitution as well. You have someone here that is looking into America's own past and now the globe's past in
and it
a
is
pretty
cool.
significant way.
It's cool that he's giving it to a museum, that he's going to put it in a museum. So it's not just going up in one of his many houses.
I must say, the dollars I'm still watching out of Ken Griffin is if he's going to make that move and donate to Trump. We know he met with him recently, but I've got to say, a lot of dollars we're watching out of Ken Griffin, but that is maybe number one.
Yeah, I think that's definitely the next shoe to watch for in terms of the possibility of a drop, right, of big money donors to Trump that hadn't previously tallied up.
Well, this is a great segue because Ohio Senator J.D. Vance officially accepted the GOP nomination for vice president, sending a message to Wall Street in the process.
Wall Street barons crashed the economy and American builders went out of business. As tradesmen scrambled for jobs, houses stopped being built. The lack of good jobs, of course, led to stagnant wages. We're done, ladies and gentlemen, catering to Wall Street. We'll commit to the working man.
And for more on the RNC, we're now joined by Bloomberg's Annmarie Hordern. And Annmarie, that is the J.D. Vance messaging. We hear from Trump tonight. What are we expecting to hear?
Well, J.D. Vance definitely took a message, one of populism, and definitely one of the MAGA base of the party, which it was pretty clear what he's going after in that speech, what the Trump campaign wants to go after. He was very rough on big business, which is interesting because the former president told Business Week he'd like a corporate tax rate, he'd love one of 15%. Doesn't really bode with the J.D. Vance style of politics and how he thinks of big business. J.D. Vance wanted to make it clear. He wants to go after the auto worker in Michigan, the factory worker in Wisconsin, and the energy worker in Pennsylvania. And this campaign is certainly going to stick him in those three states because those three states is what Joe Biden needs to make sure he can remain in the White House. When it comes to Trump this evening, he told a lot of people, including Glenn Youngkin was here yesterday, the Virginia governor, and we were talking about the fact that he spoke to Trump on Sunday and that he wanted now a new push for unity at this RNC. Trump has said that he ripped up his speech, which he said was going to be a humdinger, and now he is going to call for unity. We'll have to see tonight on whether or not he can do it.
I mean, he said that before he picked a man that some have classified as the Republican attack dog to be his vice presidential candidate. So we'll see if that happens. In terms of his opposition, President Biden has been told reportedly by Nancy Pelosi, by Chuck Schumer, by many of his closest allies and most powerful members of the Democratic Party that he needs to pass the torch. He needs to step aside. And now he's retreated to Rehoboth with COVID. how long are people there giving him until he's replaced by someone else?
Well, that remains to be seen. It remains to be seen whether or not he's going to be replaced. The president has been defiant. I will say his messaging when he is asked by the press about will he stay or will he potentially step aside has changed. You remember in early July, he sat down with ABC News, and in that interview, he said he could only be convinced to step aside if the Lord Almighty came down. He said, and the Lord Almighty is not coming down. Then at a NATO press conference, he said it was the polling, if someone showed him hard data. And then last evening, in an interview with BET, he said if a doctor had said there was some sort of a medical condition emerged, now we know who has COVID. There's a stark contrast going on right now, a stark split screen. You have basically a party here at the RNC. I said earlier, it feels like an exiled king who's come back, and they're now going to anoint him and crown him with the current president, Joe Biden, isolated, not just physically because of COVID in Delaware, but also politically.
How do you expect Trump to address all of this in his own speech during the RNC? Do we have any clues on how he might approach the Democratic Party, Joe Biden, as well as the competition he's facing on a lot of the key issues?
Well, frankly, I spoke to someone close to the former president, and they said he's been very restrained. I think, to Matt's point, he now has almost an attack dog who can go out and do the attacking, and he could try to act like a unifier. But we know sometimes for the former president, it's hard for him to restrain himself, and he might want to go on the offensive. But he, I think, and his aides are going to tell him to use this moment and actually talk about what happened to him over the weekend, the fact that he dodged a bullet, and potentially trying to unite this Republican Party, which, of course, at the RNC, they're talking about how they are so united. There are deep divisions in this Republican Party, and I think a lot of that was on display with J.D. Vance's speech yesterday.
Annmarie, we thank you so much for your coverage. Of course, that is Annmarie Hordern with Bloomberg Surveillance in Milwaukee. Remember, stay with Bloomberg Television and Radio tonight for special RNC coverage of Trump's speech starting at 8 p.m. Eastern. And still ahead, we're going to take a look at the companies making the most buzz today on social media. That is Social Climbers next. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Warner Brothers Discovery. It's the parent of CNN and HBO, considering splitting its streaming and studio businesses from legacy TV in efforts to boost its share price. This is according to the Financial Times. Now, the media giant has been struggling to improve its profitability in the face of an expensive streaming war against Netflix, which, of course, reports after the bell today. Next up, the swimming pool retailer Leslie's underwater after it slashed its full-year forecast and announced preliminary third-quarter results that missed estimates. That news triggering a wave of Wall Street downgrades. You can see shares absolute wipeout, down 29%. And finally, appetite for Domino's Pizza shares depressed today after the chain announced a disappointing second quarter. New discounts and new product launches, such as New York-style pizza, apparently not strong enough to lure diners, guys. Currently, Domino's Pizza shares down about 11% or so.
I feel like if you are eating Domino's, you've given up on pizza.
Oh, let's relax here.
Come on, it's just not very good. In fact, I don't think any of the publicly traded pizza companies are that good at all.
Papa John's? You're not a Papa John's fan?
Is also dropping 2.4% today. I love Papa John's. I love Domino's. I think you're crazy.
I think that Domino's has a place in your pizza portfolio. I think it's pretty good. But if you look under the hood of what actually they reported, also it seems like they cut their 2024 international store growth target. They're apparently facing problems abroad. And that could explain why you're seeing such a dramatic drop. And we'll see what it means for Papa John's, like you said, Sonali.
If you ever get a chance to go to Bexley, Ohio,
okay,
I highly recommend you stop into Rubino's. It's the best pizzeria I've ever been to in my entire life. No, but my parents went there, my grandparents went there, and it's simply unbeatable. Coming up, U.S. industrial output posts its largest back-to-back monthly gains in 3 years. We take a deep dive with Jennifer Rumsey, CEO of Cummins. That's next. This is Bloomberg. U.S. industrial production posting a solid gain in June for a second straight month. The gain helped by a pickup in factory output, signaling U.S. manufacturing could be regaining some footing. For more, we're joined by Jennifer Rumsey. She is the CEO and board chair at Cummins. It's a top manufacturer of diesel engines used in commercial trucks, off-highway equipment, railroad locomotives, and the Ram that I'm driving right now. Jennifer, thanks so much for joining us. I think of you primarily as a maker of a technology that many people think is going to be extinct soon. How much longer do we have internal combustion diesel motors?
Yeah, well, as you noted, diesel engine is a great power solution that powers many of our commercial and industrial applications today. Highly efficient, highly reliable, and our applications, which are very different than passenger cars, are going to require different solutions as we decarbonize. Cummins has a strategy we call Destination Zero, which is focused on doing just that. And what I will tell you is that strategy requires us to continue to invest in engine-based solutions that can reduce CO2 for our customers, as well as zero-emission solutions through our Accelera by Cummins business, starting to bring these battery electric solutions and hydrogen solutions to applications where it works. But it's going to take time, and that's why we're really focused on growing our business and investing in a whole range of solutions for our customers.
Now, how much more time do you have in terms of the diesel motors? And right now, I believe you're the world market leader in terms of the big Class 8, truck motors. Are you being pushed out of that business by regulations? Is it too expensive to develop new diesel motors?
Yeah, so here's what we're seeing. Cummins is, as you noted, the largest independent manufacturer of diesel engine customers. So what that means for us now is for certain applications, we're starting to see a move away from diesel engines. Transit bus and school bus is a great example of that. They can put an infrastructure in place to support them. It's much different to do a heavy-duty long-haul truck because of the power and range that's required. So we see that taking much longer. Because we are the largest independent manufacturer, we can afford to continue to invest in next generation, highly efficient engine platforms. And some of our customers are now seeking us to play a bigger role for them in providing engine-based solutions. So you may have heard us talk about our HELM engine platforms, which stands for high efficiency, low emissions, multi-fuel. We're investing $1 billion in our manufacturing network here in the U.S. for engine-based solutions that are high-efficient diesel, as well as alternate fuels like natural gas, renewable natural gas, and hydrogen. So there's still a lot of innovation and opportunity in front of Cummins and our industry for engine-based solutions.
Well, let's talk about the here and now when it comes to heavy trucks, because you take a look at June's orders. They were relatively weak. You and I spoke in February about how the industry consensus was that we were going to see a bit of a downturn, a modest downturn. How is it playing out relative to your expectations?
Yeah, pretty similar to what we talked about in February. We're coming off of a record revenue year, $34 billion, really strong performance for Cummins in 2023. We've projected to be down 2 to 5%. In 2024, that heavy-duty market is one of the big factors driving it. Some of our other markets, like vocational, power gen for data centers, is continuing to be very strong. And so we think in particular in the second half that some of the back order that had caused our business to continue to stay pretty strong is starting to come down, and that we will see softening in that market in particular.
Well, that's exactly where I want to go, is the data center demand that you're seeing. I was taking a look at your first quarter earnings call back in May, and you were projecting at the time that the power gen business was going to be up 10 to 15% for the year. Of course, a lot of that coming from that data center mission there. Are you seeing any signs of plateauing demand there, or how does it look, of course, as we all continue to gravitate around that AI story?
Yeah, I mean, the data center demand continues to be really, really strong. We have 2-year backlog on our order board. We're investing to double our capacity in our 95-liter engine, which is really popular in the data center application. And we see that market continuing to be a really strong growth market for Cummins, and we're well positioned with our current products, some of the new products that we have launched, like the Centrum product series, and also the fact that we bring together our power systems business that makes those products with our distribution business that can help install and support our customers in that market.
You know, Jennifer, I'd love your opinion here on how you see yourselves operating through the current economic environment, because last year was very strong for you guys, and this year you see the signs of the economy slowing a bit. And if you think about any potential for a cyclical downturn in the next 12 to 18 months, how do you have to prepare for that with your end markets?
Yeah, I mean, Cummins is in a cyclical business, so we're used to navigating ups and downs in our markets. And what we're doing, which we consistently do, is when we start to see a downturn, we take that as an opportunity to step back and say, are there areas of our business we want to restructure and optimize our business? And we continue to invest in critical products and technologies for our future. Our Destination Zero strategy, those investments in the Helm platforms that I mentioned, some of the key investments that we're making in our Accelera business for zero emission solutions. And you've seen us, announce just in the last month the investment in establishing the Amplify Cell Technology battery cell plant with our partners Daimler and PACCAR in Mississippi. We're creating 2,000 manufacturing jobs, and together as partners investing $2 to $3 billion. And just last week we announced an investment in one of our original plants here in Columbus, Indiana, for electrified components here, $150 million there with some DOE money supporting that, and we'll create 250 new jobs in our headquarters community of Columbus. So you see those investments continuing because we believe that positions Cummins to continue to grow through the medium and long term.
Also curious about how you're thinking about the next 12 months in light of what you're seeing in the political landscape. Would there be a difference between how the Biden administration has treated, of course, many aspects of your industry, you think just in terms of green energy, versus how Trump would treat this industry and what that would really mean for you if you were to become president?
So we have and will continue to work across both of the parties, educating them on what we think is important for our business, for success in our communities. We're going to continue to do that. We believe that having investment in these clean technologies is an important part of our future. That's driving the investment in Mississippi and here in Columbus on clean energy technology. We'll continue to advocate for that, as well as ensure we have clear regulations and policies that enable businesses to be successful. We want to have stability really across years to allow us to know when and how to invest and run our business. And by doing that, it helps us continue to create jobs.
I still wonder if there's any chance of regulations that can allow your workers to put these diesel engines together longer. It's been a union in decline. I think there were 7,000 or 8,000 members of the diesel workers union 50 years ago, and now there are less than 2,000. Do you lobby at all to push out regulations so that you have more time to give these workers, a livelihood?
Yeah, what we're lobbying for is tough, clear and enforceable emissions regulations and that are consistent. And Cummins has advocated for environmental regulations on diesel engines for decades, and we've grown our business as a result of that. We've created jobs as a result of that, and we're continuing to do that. We have to recognize that these transitions take time. So let me just highlight that plant here in Columbus, Indiana, where we're investing, and that, by the way, is a diesel worker union plant. We're investing in next generation diesel engine blocks and heads in part of that plant. And then in part of that plant, we're investing in these electrified components and creating new jobs. And so we want to do this in a way that works for our customers' business, for the U.S. economy, and also recognizes that we have an environmental challenge in our planet and a responsibility to address that in a way that does work for the economy. And that's really what we focus on.
All right, Jennifer, it's great to speak to you again. Really appreciate you taking the time. Our thanks, of course, to Jennifer Rumsey of Cummins. Meanwhile, you take a look at markets right now. The S&P 500, the NASDAQ 100, giving back their gains. The NASDAQ 100 in negative territory right now. Let's get more on these markets with Bloomberg's Abigail Doolittle.
Yeah, let's take a look at the shares of the NASDAQ, or take a look at the NASDAQ 100 itself over the last 3 days, because we'll see that decline you're talking about on the day down just slightly, but earlier it had been up, let's call it 0.4%, somewhere in that area. A rebound rally from yesterday's big decline, down nearly 3% yesterday. That was the worst sell-off since December 2022. Of course, that was a very rough year for stocks. So investors not really sure or whether they should be buying this dip. But let's take a look at what's happening beneath the surface, because there's some real tension between the mega cap tech stocks. So NVIDIA, we're seeing a bit of a bounce back, but well off of its highs, now up 0.8%. It had been up closer to 2%. The key level on this stock is about 118. If below 118, we could really see this stock go in free fall toward 100, even below. If it holds on to 118 and can eat away at its 15% decline from the peak, well, then it'll be a different story. Tesla bouncing back from yesterday, up nearly 2%. To the downside, though, Apple and Microsoft both lower. These, of course, are the two biggest weights, the NASDAQ 100 and the S&P 500. So if they continue to weigh, that could be a problem for the major indexes. And, of course, the sentiment that we've had around big tech for a couple of different reasons. That is one reason that we have these stocks down, including the possible chip crackdown on China. And then it looks like the Trump ticket may not be so positive toward tech. When we put all this together for the NASDAQ 100, there's some serious call buying on the recent dips. But I would note, and this is very important, so over the year, you can see that we have it. Thank you, Matt. Over the year, you can see that we have this nice uptrend. But take a look at this broken uptrend. So this call buying comes as the buyers are really weakening. When you have a trend break like that, because the trend line's never to see the trend. You can see the trend with no problem. It's to see when it's starting to reverse. It is starting to reverse. The question is, how far and how long, Katie?
All right, Abigail Doolittle, thank you so much. Of course, watching the NASDAQ 100 slip about 0.2%, small caps up 0.5%. So maybe this rotation finding some new life. Coming up, the disconnect between the actual and the perceived economy. Former National Economic Council Director Laura Tyson weighs the factors that matter for consumers. This is Bloomberg. All right, it's time now for our daily Wall Street Week conversation. And economic indicators suggest that prices are cooling, but the reality may not be changing consumers' perceptions. Former National Economic Council Director Laura Tyson tells David Weston why the perception is so hard to change.
The majority of economists are probably surprised. And I think the Fed, we heard today from Jerome Powell, I think he's surprised. The resilience of the economy, given that we've had high interest rates, we've had them the highest in 3 decades, we've had them for a long time, that should have slowed the economy down. It did not. So what is the driver here? I think the investment strategy that has been unleashed by the private sector in response to Biden's industrial policy in semiconductors, his industrial policy in overall manufacturing, his climate policies, those tax cuts, those tax incentives for climate investment have unleashed a lot of investment. And so if you think about this, this is spending that's investing in the productivity of the future. I want to add to this AI, a lot of investment in AI because of the anticipated effects on productivity.
So let's continue on that if we could, because in the past you and I have talked about when you were in the White House and you saw the internet kick in that really affected productivity. Now that we know a bit more about AI, do you think we're maybe on the threshold of something like that?
You know, I think we could be. I have done some work on this. Look, we don't have a lot of evidence right now, but all the evidence we have, whether we do it through how does a programmer benefit from working with AI? How does a call center operator benefit from working for AI? All of the numbers say significant productivity growth. So I think it's largely anecdotal, largely case studies. We don't have enough yet, but boy, the promising signals that AI will lead to a significant boost in productivity growth, it was the major surprise in the 1960s, and it may indeed be the major surprise in the next 5 to 10 years.
So you're an economist. At the same time, when you were in the White House, you had to pay attention to the politics as well. Given the fact that you see the economy as strong as it is, why are so many people so dissatisfied, even some of them angry with where we are economically?
You know, there's no simple answer to this. If you look at all of the numbers, the only number that does not generate the same kind of benefit for the population are the inflation numbers. So if you look at GDP growth, or you look at employment growth, you look at the unemployment rate, you look at vacancy rates, you look at you look at the rate of growth of real wages now since January 23. Those are positive numbers. The thing that really gets people, I understand this, is the prices of things that they need are higher. They are higher. They're not, inflation is not, we're not going to disinflate. Prices are not going to go down for most things, so prices are higher. And I think there you have a lot of service prices, people going out to restaurants now and realizing that the price includes the price is higher service charge. It costs more to do it. I would say housing. Housing is a huge national problem. And I think we've only recently seen the last quarter 2 of this year, we began to see some easing in the inflation rate of housing.
Part of the issue is the economy. Part of it is how you communicate about the economy. You worked under somebody that I think was a very strong communicator. You can agree with President Clinton or disagree, but boy, he was a good communicator, and he would explain what's going on in the economy. How do we avoid the populist streak that we're seeing right now? Because I think a lot of Americans, whether rightly or wrongly, are saying that inflation is linked to some of the investment that you think is a good thing.
Well, I think we have to, again, if you listen to, and I'm not sure that this is a populist message, but if you listen to Jerome Powell today, he would say, okay, look, we had a very set of tight supply chains as a result of COVID. That's a tightness in the product market lasted a long time, longer than we expected, okay? But then you have that unleashed, you have the prices in goods starting to slow or even come down somewhat. And then what are people spending their money on? Their pent-up demand is on services, it's on vacations, it's on going to restaurants, it's on having a normal life outside of COVID. And those prices go up. I am very concerned, by the way, and you haven't raised it yet, but I'm going to go to immigration here. If you think that there are numbers on this, the employment rate of native-born working-age Americans has been stable, okay? It's not gone down from 2019. It's not gone up from 2019. What's going on here? The number of working-age Native Americans is going down. It's going down. So all of the employment growth that we have seen over the past 3 years has been non-native born working age population, immigrants.
And that was Laura Tyson of UC Berkeley in conversation with Wall Street Week host David Weston. And tomorrow we'll hear from Owen Thomas of Boston Properties on recovery in commercial real estate. This is Bloomberg.
Let's get directly to the trading diary, what you need to be watching today and tomorrow. Tonight is the last night of the Republican National Convention, which will include a primetime speech from Donald Trump. That's at 8 o'clock. You can tune in on Bloomberg TV to see that, or type TLIV go on your terminal. We also get Fed speak throughout the day. Lori Logan is going to talk. Mary Daly is going to talk. Mickey Bowman is going to talk. So pay attention to that. Also on the terminal, TLIV go usually works, plus Fed go. And Netflix reports results today after the bell. We will be waiting with bated breath, and I'm sure that Romaine is going to cover that on the close.
Well, before we get to the close, let's cover it on Open Interest. We're going to do that with Geetha Ranganathan. She is U.S. media analyst at Bloomberg Intelligence. So Netflix really kicking off big tech earnings. And when it comes specifically to Netflix, I assume that all eyes will be on subscriber growth, for example.
Absolutely, Katie. And as much as they try to drive the conversation away from subscriber growth, we know that just last quarter they said that they're going to completely stop disclosing subscriber metrics altogether starting in 2025. You know, the conversation still centers around subscriber growth. And this quarter, I mean, we saw them last quarter report really, really strong numbers, over 9 million new subscriber adds. And it looks like that momentum is pretty much going to continue. So consensus right now expecting about 5 million new subscriber additions for the second quarter, but I think investors are generally expecting much higher, around 6 to 7 million.
So what does that mean for the future of Netflix, the stock, given that this is already what you expect out of subscribers?
So I think for the most part, Sonali, what we've seen is that Netflix has really kind of won the streaming wars here. And now it's really coming down to execution. So they have a couple of these new initiatives in place, which I think they've executed really well on. And we're kind of seeing that in the numbers as well. Subscriber numbers are pretty high. You know, it's kind of boosted revenue growth as well. They are the largest streaming service now with, 270 million subscribers. And in the meanwhile, you have all of their competitors kind of really, really struggling. We're seeing talks of a lot of M&A activity potentially happening with more streaming services kind of bundling or joining forces. So it's clear that at this point, they are the dominant streaming service. They are in a league of their own. Their brand, their scale kind of gives them that durable competitive advantage over the long term, and it really supports that hefty valuation.
Is Netflix, are they leaving a lot on the table in terms of advertising, or do they not have to worry about that considering their total dominance?
So advertising, Matt, is still pretty much in the early stage. Remember, they only introduced the ad tier just a few months ago. So it's still very much, in the nascent phase. But having said that, they do have 40 million monthly active users. So that's a sizable number. But they really want to get that to a much, much greater proportion of their user base. And so they are introducing programming that is going to support the growth of that ad business. So they are investing in live sports. Now, that is something that really appeals to advertisers. They're going to have 2 Christmas Day NFL games. Mm-hmm. They're going to have WWE programming starting from 2025. And then just a little bit later this year, they're going to have that very famous Jake Paul versus Mike Tyson. So they are doing things to diversify their portfolio and build that ad business.
All right, Geetha Ranganathan of Bloomberg Intelligence, really appreciate that preview. Netflix after the bell, and coming up tomorrow on Open Interest, Abby Joseph Cohen, Matt Miskin, and Sally Krawcheck. A lot to look forward to there. This is Bloomberg.